So remember that dog and pony debt ceiling show that we had all of last month? Well, that's over. It's done. Debt ceiling crisis averted. All is good, but not really. Now comes the consequences. You see, the US Treasury is looking to issue about $1 trillion in bonds to raise capital. This is a way that the US government raises money. They issue a bunch of interest-paying IOUs and then spend the money on making the interest payment on the existing debt, Ponzi, and then other things to stimulate and stabilize the economy. But who will buy these bonds? Well, more than likely investors looking for a higher rate and a lower risk. So expect the stock market to take a hit. Or maybe the big banks will have to buy them because of a new regulation where the US Treasury is forcing big banks to increase their reserve requirement by 20%, which will have everyone, including banks, looking for these bonds since they fulfill that reserve requirement. So how's this going to impact mortgage rates? Because, that's what we're here for. Well, in theory, good. But who knows at this point, since the fundamentals don't really apply right now. Everything's backwards. It's sort of like opposite day. And on that note, good afternoon, everybody. Luis here, wishing you a happy Taco Tuesday. And this is your weekly market update video to give you some sense of where the housing market is at and where it's going. Again, if there's anything that you want me to research and confirm or cover, simply reply to my email or comment below. So let's begin. There is so much happening. So remember how rates were supposed to drop in May because inflation was tapering off and going down? Then we had the debt ceiling crisis, right? And if that wasn't resolved, a default would occur and rates would go through the roof due to the risks. Now that that's resolved, we have oil production concerns as Saudi announces that they're going to be cutting oil production, and that's all inflationary. So it causes mortgage rates to go up. And to top it off, last Friday's jobs report showed that there was a massive increase in job creation, and that's inflationary as well and causes rates to go up. And I mean, it doesn't make sense. How do you have massive job creation and an increase in unemployment? Could it be that there's an increase in part-time jobs? So one person could be working 2 or 3 jobs to make ends meet because they lost that one job. Well, that's something to think about. So why am I sharing all of this with you? Well, it's to give you a little more insight on how the fundamentals aren't really applying right now because there's always something new that comes up. First, it was the inflation. Next, it was the debt ceiling. Then oil production issues. What's next? So let's see what the 10-year bond is doing. It was supposed to have dropped massively as inflation tapers down, as inflation concerns taper down. But things have been very volatile. And we're pretty much the same as last week. I mean, it's at 3.67% this week, and last week it was right around 3.69% to 3.72. What does that mean for rates? Well, here are today's interest rates. This is all based on a $500,000 purchase owner-occupied single family and a 740 FICO score. First column on the left, you got VA at 6.25%, which is down about 0.25% from last week. The FHA loan program is at 6.25. It's unchanged. It's pretty much the same. And then conventional is the same at 7.25%. So rates are pretty much the same. However, the price of homes, depending on the area, are increasing. And so are the rents. I know all of this sounds a little confusing and discouraging, but eventually things will have to settle down. They'll have to turn, and that's going to drive home prices even higher. So imagine if we had a 3% interest rate right now. What would that do to the number of additional buyers competing for that same house? In short, if you're a renter, get into the market. Call me and I'll break it down. All right? Follow me on Instagram and DM me if you have any questions.